But I actually want to go right into Emily and get her a couple of trade ideas that I asked her to bring, to the show here today. We're talking this morning. I told the Queen, we would love to see one or two stocks that you're watching, thinking about. Emily, what you got?
I've got quite a few, but we'll start with Docusign, if you will, Matt. And give me a daily. Now, we'll come back and look at the weekly. But Docusign really has just been on this, sideways channel, ever so slowly inching up. Since probably about July or so. So it had the huge run up, obviously, like everything else did 6 months ago, but then it's been on this sideways channel. And I like how it always finds support and resistance, and you can literally see it bouncing off of support at that 225, 230 range, and then always bouncing out, finding resistance at 260. So here we are, we dropped back down, found support. We're above those moving averages right now, just about to clear, I think that's the 9 or the 20, but looking to play this and try to catch that momentum back up to 260. And I'm considering either doing a bull put or a bull call. And I've looked at both, and I'm kind of leaning towards the bull call because I kind of see the potential of it just getting up to 260. So I'm looking at the March monthlies, and probably looking to do the 250, 270. Now it does have an ATR of about $10 and some change. So my stop loss will really be below today's candle, just slightly below today's candle, because that's about the ATR that it moved today. So if I'm looking to have a stop loss right around that range, and I get in at 250, buy the 250, sell the 270, it will cost me about $600. But technically I'm risking about 135 for a potential 310 if I built that out properly. That would be the bull call. If I do the bear call, that would be the bull call. If I do the bull put side of it, I'm going to give myself cushion. You guys know I love to give myself a little bit of cushion. So I'm going to go out and probably look at the selling the 200, the 210, buying back the $210 wide.
Are you looking at February monthly?
No, on the bull call, on the bull put, I'm looking at the March 5th.
March
the 30-day.
So 5 March 21.
You're
Okay.
playing the weekly?
Mm-hmm.
Okay.
So if I do that, I'll pick up about $1.24, which is well within my, my cash flow.
What strike are you doing in?
We're going to sell the 210.
210.
Mm-hmm. Okay. And buy back the 200.
When do you guys go to a 10-point spread versus a 5-point spread?
It's a really good question. Obviously, when the stocks are up above $200, I start considering it. I was actually looking at the 5 and the 10 spread as Emily was talking here and looking at the differences. I kind of like both in different reasons here. The 210, 200, you got 10 points of fixed risk. The 210, 205, you get a little bit better ROID, which if you're a cash flow trader who understands our Tackle Theta spreadsheet, you'll identify that. Emily, why the 10 for you? I mean, I think both are viable for sure, but
both are fine. I'm just curious.
Yeah, I'm just so ingrained in just doing the 10 when a stock is over a certain price point. If a stock is over $200, I usually just aim for that. But typically I'll do 5. Sometimes I'll even do $3. Right? If I've got that choice. But typically I'm between 5 and 10. But for me, it's just, and it's also easy for me to just figure out the math and the calculations and my ROI too in my head.
Plus it's the 200, which means you're always going to have a slightly more liquidity there.
Yeah, yeah. I mean, you go through all these things where you look at, the open interest and the volume in them as well too. So sometimes I'm forced to do a $5 wide if I don't want.
One thing very quickly, you see these, strike price differences are so vastly different in the market today than when we all grew up traders. I mean, it's random. Every stock is a little bit different. Some have 2.5, 1, 50 cent. I mean, it just randomly varies. But when you're looking at doing spreads and you're trying to determine which one of these to sell or buy or whatever the case is, take a look at these weird ones very quickly before you just decide to jump. Yep. Because Tim and myself were obviously talking 200 by 205. We knew the 202 was nothing to even look at. We knew that. You might not know that. So just word of thumb, you can be the first, but you typically don't want to be the first. So
And
check
look at
the
the
volume,
now.
check the open interest on these non-standardized strike prices, 202 and a half, 20, like you just got to check. Sometimes they're traded, sometimes they're not, but just check. So 205 versus 200. I get it.
Yep. And for the conservative person that wants to still get them, but maybe wants to give themselves a little bit more cushion, you could still also do the 205, 195, pick up a little bit less on premium. You'll get about 84 cents on that, but you give yourself a little bit more wiggle room to the downside.
Yeah.
And you're below those moving averages as well. You'll be below the 200,
Okay.
the 200 average.
Can I interest you? Because here's what I like on this. I do, because I'm out on the bull call. Like, I don't love the rounding top here. I don't love the failure of all these support levels. And now you're back into just neutrality here, in my opinion. Now, you could argue that this is a slight increase in support and this is a slight increase in resistance. You could argue that. So I'm not saying what I'm saying is God's word. This is my subjective opinion based on my analysis. So I would say you got a little bit too deep of retracement without a breakout that was legitimate, that actually saw a leg up. This would be neutrality. And so because I got a reading that is not a bias one way or the other, I'm immediately going to go to the bull put side of it. And I do like the bull put side of it. Now, if you sell that 31-day contract at 210 by 200, this is your range right here, right? This is your range. Now, if you guys know the tackle trading spreadsheet, we look at ATR differences in the tackle trading research spreadsheet. And what that would show you here today is that 210 gives you about a 3 ATR range on that position. And that's perfectly fine. There's nothing wrong with that. Not at all. You get 3 ATRs on a 30-day contract, you're good. Anything above 2 is fine, right? You want to get into the 4, but we're talking about DocuSign. We're not talking about Pfizer. Maybe not today. Pfizer's going down pretty hard today. But you get the point. We're not talking about a value paying dividend stock, right? So when I'm looking at this, if I can go out and get down at least here, see, my eyes just gravitate here. I go to here at that 210M and I'm like, yeah, I can see a slight support level, because if this movement does start clipping, you're going to want support. You're definitely going to want support. And so I see this 210 level and I'm like, I'm not comfortable with that 210 level, because my max risk is down to 200, and at 200 is where I have major support. I would like that strike sold at this level with that max risk. If the end of the world happens and we clip that 200-day moving average, my max risk then coincides with the violation of the 200, which is okay, versus my max risk being at the 200-day moving average, which is what you would expect to see a bounce. And you certainly don't want to get to the hoping and the praying and starting to sing to yourself about how things are going to work out at a better place down the road, simply if that 200-day moving average holds for you. You don't want that emotion in your life. And so what I like here, and I'm just making a suggestion here, what I like is kind of taking the stance of, you know what, I know we target these short options so many times because of theta. We love to take advantage of theta. We're not going to get the theta decay in the $45 call option. You're just not. If you look at the, let's go to delta and theta and gamma and rho, you sell the 210 here, you buy the 200 here, not the 45, let's go to the 31. You sell the 210 here, you buy the 200 here, you're capturing about 3 theta points at the starting of the trade. Now that will get better, but that's what you're capturing, about 3 theta points. If you go out to 45 days, it's going to be fairly similar there. You got 15 theta there, you sell that 200 there, we got 210 by now 200, right? Well, I'm selling the 200 and we're buying the 190. So you're not going to get as much theta. You're getting 2 theta points for 3 in the 31 day, but that's going to increase over the next 7 days to where you are going to capture 3, then a week later 4, then a week later 5, 6, 7, 8, 9, 10, right? So I like the trade with 45 days to go. You're working in the monthlies, which is much more liquid, which means management is going to be easier. Getting in and out is going to be easier. You get a little bit more, directional, coverage from the 240 down to 200 instead of 240 down to 210. And number one is you got this little thing right here. And I know it's an arbitrary little line on a chart somewhere, but those investors look at that line and they're going to battle for that line like it's trench warfare in World War I. And I want that level of support fighting for my little soldier called the bull put spread. So I like the 245 days. I like the trade. I like the setup. I just like the 45-day contract with the 200 by 190. What do you think? Did I convince you?
Yes.
Did I get you? All right, I got you.